Welcome to Talk Tickers. We're your shortcut to understanding crucial earnings calls.
And today we are diving into Western Alliance Bank.
That's right. Their first quarter of 2025 results just came out. We're going to unpack them.
Yeah, the big question, I think, is how well positioned are they right now, given, everything going on economically?
Exactly. So let's jump right in. What did the headline numbers look like for Q1?
Okay, so first off, they basically hit their own expectations. No big surprises there, which can be reassuring.
Always good to meet guidance.
Right. And pre-provision net revenue, PPNR, came in at $278 million.
Okay, $278 million. How does that stack up?
That's actually up 12% compared to last year.
Yeah.
So a pretty solid increase in core profitability before you even think about loan losses.
Got it. And net interest income, NII?
Also up. Grew 9% year over year, hit $651 million.
That seems pretty healthy. What about the margin, the net interest margin?
Reported NII was pretty stable, 3.47%. But, and this is interesting, the adjusted NII, which includes deposit costs, that actually ticked up to 2.75%.
So managing funding costs well then?
Seems like it. Suggests maybe strong deposit relationships or finding cheaper funding somehow. It's definitely key in this environment.
Absolutely. And asset quality. How are the loans holding up?
Also looks stable. Net charge-offs, they actually went down just 20 basis points for the quarter.
Wow, down. That's good to see.
Yeah, and because of that, the provision for credit losses, the money they set aside, that was way down from last quarter, only $31 million.
Fewer bad loans, less money needed for potential future losses. Makes sense.
Exactly. And non-performing loans also decreased a bit, down to $451 million. That's about 82 basis points of their funded loans.
Okay. And for the long-term view, tangible book value per share.
Looking good there, too, up 14% year over year. Reached $54.10.
14% increase. Nice. Okay, let's dig into that net interest income a bit more. That $52 million year over year jump. What really drove that?
Yeah, that $52 million was the main story year over year. But quarter over quarter, it actually dipped slightly.
Oh.
Why was that?
They said it was mainly just because Q1 had 2 fewer days than Q4. Just a calendar thing.
Okay. That makes sense.
But here's the interesting part for looking ahead. Their loan balances at the end of the quarter were quite a bit higher than the average balance during the quarter.
So they finished strong.
Exactly. Which suggests, momentum. It could point towards NII growing again in Q2 and beyond if that holds.
Okay, interesting. What about the other side of revenue, non-interest income? Fees, gains, that sort of thing?
Pretty flat year over year, actually. Came in at $127 million.
Any notable moving parts within that?
Yeah, a couple of things. Mortgage loan production volume was way up like 25% annually.
Wow.
But the gain they made on selling those loans was down. So kind of a mixed bag there.
Okay, volume up, margin down.
Right. And there was also a charge they took on an equity investment that pulled the total down a bit. They do expect to recover that later, though.
Got it. All right, let's flip to expenses. Non-interest expense, did they manage those well? They did, yeah. It actually decreased. Came in at $500 million, which is down $19 million from the prior quarter.
What drove the decrease?
Mostly lower deposit-related costs. That ECR stuff we'll probably touch on later.
Okay.
And that decrease was enough to offset the usual seasonal increases you see in Q1, like compensation and benefits.
So managing costs effectively, did that help their efficiency ratio?
It did. Their adjusted efficiency ratio improved to 56%. Lower is better there, obviously. Shows it's costing them less to make each dollar revenue.
Good trend. So NII up year over year, expenses down quarter over quarter. Sounds like the balance sheet was growing too.
It was. Total assets expanded, hitting $83 billion.
And what fueled that? Loans, deposits.
Both, actually. Loan growth was about $1.1 billion, and deposit growth was even stronger at $3 billion.
$3 billion in deposits. Nice.
Yeah, and because deposits came in so strong, particularly from their mortgage warehouse business, they actually paid down borrowings by $1.4 billion.
Replacing borrowed money with deposit funding, generally cheaper.
Usually, yes. And their total equity increased too,
Right.
partly helped by some preferred equity they issued at the REIT subsidiary.
Okay, strengthening the capital base there. Let's break down that $1.1 billion in loan growth. Where did it come from specifically?
The main driver was commercial and industrial loans, CNI. That was the biggest piece.
Okay.
Commercial real estate and construction also grew, but not as much. Interestingly, residential loans actually decreased slightly.
So a real shift towards C&I lending.
It looks like it. C&I is now 44% of their main loan portfolio, up from 39% just a year ago. So yeah, definitely a growing focus.
And regionally, any standouts?
Yeah, they mentioned good growth in home builder finance and also just growing relationships within their existing markets. On the national side, it was mostly driven by lender finance.
Got it. Now, that $3 billion in deposit growth, that's pretty significant. Where did that flood of deposits come from?
A lot of it, impressively, was in non-interest-bearing accounts.
Oh, the best kind for a bank. Free money, essentially.
Exactly. Very valuable. They also saw growth in savings and money market balances.
Any specific business lines contributing?
Yep. The mortgage warehouse deposits showed that seasonal strength again. And their HOA services homeowners associations, those deposits actually crossed the $10 billion mark now.
$10 billion in HOA deposits. Wow.
Yeah, it's become a real niche for them. Plus, specialty escrow services grew, and their corporate trust division pulled in nearly $300 million too.
So broad-based growth, but especially strong in those non-interest-bearing and specialized areas, speaks well of their relationships, I guess.
I think so, yeah. Shows stickiness.
Okay, let's pivot back to asset quality. You mentioned charge-offs were down, but I did see a note about criticized assets increasing. What's the story there?
Right. Good catch. Criticized assets did tick up. That includes both special mention loans showing potential weakness and classified loans, which have more defined problems.
So more loans flagged as potentially problematic.
Yes. But the bank was quick to point out that these loans are already reserved for, or they've been written down to current market values. So they're trying to be proactive.
Okay, acknowledging the issue and accounting for it.
Exactly. And despite that rise in criticized loans, the overall non-performing assets as a percentage of total assets actually dipped slightly.
Interesting. What about their overall allowance for credit losses, the ACL?
The ACL ratio did increase. They built that cushion a bit more. And management's commentary was basically that they feel it's conservatively positioned, even for, potentially tougher economic times ahead.
And I mentioned their portfolio mix helps too, right?
Yeah, they pointed out they have a higher weighting in things like those mortgage warehouse loans compared to some peers, which they see as lower risk categories.
Makes sense. How are the capital ratios looking after all this growth, particularly CET1?
The Common Equity Tier 1, or CET1 ratio, dipped slightly, down to 11.1%.
Why the dip?
Mainly just due to the loan growth, assets grew, so the ratio relative to capital came down a bit. But it's still comfortably above their internal floor, which they stated is 11%.
So still meeting their target.
Yeah. And the tangible common equity to total assets ratio held steady at 7.2%. Plus, that preferred equity deal at the subsidiary we mentioned, that actually boosted their Tier 1 leverage ratio up to 8.6%.
So overall, capital levels seem solid, still above their minimums.
Seems that way, yes.
All right, looking ahead, they gave guidance for the full year 2025. What are the key targets?
Okay, so for the full year, they're aiming for about $5 billion in loan growth.
Okay.
And even more on the deposit side, targeting $8 billion in deposit growth.
Ambitious deposit target.
It is. They expect CET1 to stay above that 11% level.
Got it. Revenue.
They're forecasting both net interest income and non-interest income to grow in the range of 6 to 8%.
Okay. Growth on both top lines, expenses.
Here, they're guiding for either flat expenses, zero growth, or even a decrease of up to 5%.
A decrease.
They specifically mentioned expecting those ECR earnings credit rate costs on deposits to come down through the year. They gave some specific numbers for Q2 and the full year on that.
Okay, so lower deposit costs helping the expense line. What about charge-offs and taxes?
They expect net charge-offs to stay low, around that 20 basis point level we saw in Q1, and the effective tax rate should be roughly 20%.
Okay, seems like a confident outlook overall. What was the general vibe from management during the call? What themes did they keep hitting?
They really push this idea of being a bank for all seasons, highlighting their diversified business model, different sector expertises, trying to show they aren't just a one-trick pony.
Right, emphasizing resilience.
Exactly. And they talked a lot about strengthening the balance sheet, more capital, more liquidity. They mentioned seeing healthy loan pipelines, suggesting Q2 growth could even be better than Q1.
And their main focus, profitability, growth.
Their stated focus is growing that pre-provision net revenue, the PPNR. And interestingly, they said right now, they think sustained loan growth is the best use of capital.
Meaning
don't expect big stock buybacks anytime soon. They see reinvesting in growth as the priority, especially as they're aiming to compete more with the biggest national banks.
growth over buybacks for now.
Yeah,
Makes sense if they see opportunities. Anything else?
Yeah. They also mentioned actively improving their treasury management services. That's helping drive higher service charge revenue, contributing to that non-interest income growth they're guiding for.
Okay. And they expect NII to keep climbing through the year.
Yes, they guided towards sequential growth in NII and also margin improvement as the year progresses.
What about the bigger picture? How are they thinking about the economy, potential risks like tariffs, interest rates?
They said they're watching everything closely, of course, macro developments, tariffs. But right now, they don't see significant direct exposure for their specific borrowers from things like tariffs.
Okay. And rates.
Their updated forecast now includes 2 25 basis point rate cuts by the Fed before the end of 2025. That's baked into their planning.
2 cuts this year. Got it. And longer term, they're approaching that $100 billion asset mark, right? I mean, talk about that.
Yep. They acknowledged it and said they're actively preparing for the regulatory changes that come with crossing that threshold. They expect that might happen late 2026 or maybe early 2027.
Good to see them planning ahead for that. Okay, so let's try to synthesize this for listeners. From an investor standpoint, what are the key takeaways here?
Well, first, that clear strategic shift towards C&I loans is important. That's where they're placing their bets for growth.
Okay, portfolio mix changing.
Second, the stable asset quality, especially with charge-offs declining, that's pretty reassuring given the macro backdrop, though some might still look at their overall ACL ratio relative to peers.
Right, the allowance level.
Third, that really strong deposit growth, especially the non-interest-bearing kind, is a definite positive. Shows franchise strength.
Hard to argue with strong, cheap deposits.
Exactly. Fourth, the 2025 guidance looks positive, aiming for growth and profitability, but achieving those fee income targets, the non-interest income growth, that's something to watch closely.
Yeah, hitting that 6-8% might require good execution on things like treasury management.
For sure. And finally, management's focus on organic growth, on using capital for loans rather than buybacks right now, that tells you a lot about their long-term strategy and competitive focus.
Building the bank versus returning cash immediately.
Pretty much sums it up.
All right, it's time for that segment we call This Is Not Financial Advice. We take what we've learned and spin out a, let's say, wild yet plausible scenario. What have you got for Western Alliance?
Okay, all right, so think about this. Western Alliance has shown really impressive strength in gathering deposits, right? Especially those sticky HOA and corporate trust ones.
Right, the $10 billion in HOA alone.
Exactly. And they're clearly focused on deepening relationships, boosting fee income with services like treasury management. So here's the thought experiment. What about a long position in Western Alliance, ticker WAL?
Okay, going long wall.
But to make it wild, you pair it. Pair it with a short position and maybe another regional bank.
Right.
One that seems, let's say, more reliant on more volatile funding like wholesale borrowings, or maybe has less diversified deposits and fewer levers to pull on the fee income side.
So betting on WAL's funding strength and fee potential against a potentially weaker peer.
Kind of. You're leveraging WAL's sticky, growing deposit base and their push for more service revenue against a bank that might be more vulnerable if funding markets get choppy or if loan growth alone isn't enough. It plays on that divergence in funding quality and revenue diversity within the regional space.
Interesting angle, betting on quality funding and service growth.
But again, huge disclaimer here. Purely speculative thought experiment. Absolutely not financial advice. You absolutely have to do your own homework before considering anything like this.
Understood. Do your own research, folks. That was our deep dive into Western Alliance Bank's first quarter 2025 earnings. We hit the key numbers, what management's thinking, and even cooked up a trade idea.
Hopefully that gives you a good picture of where they stand. Lots to digest.
Definitely. What stood out most to you? Do you have more questions? Keep digging. Stay informed.
And we'll catch you next time on Talk Tickers.